Hi, guys, and welcome to Chapter 4. So here's a bit of an overview of Chapter 4. We're going to start off talking about the audit risk model and its components. This is actually going to be the hardest part of the chapter conceptually. And then after that, it should be pretty smooth sailing, talking through these various risk assessment procedures, and the latter half of the chapter is about the fraud triangle. So we're going to begin by talking about the various components of the audit risk model. So basically, we'll be talking about lots of different types of risk that the auditor encounters and considers during the audit. The first one of these is engagement risk. So engagement risk is made up of litigation risk, which is the risk that this client could expose me to potential litigation. And engagement risk is also made up of reputational risk. So this is the risk that something about this client exposes me to reputational damage. It could be because their business is risky or even inappropriate in some way. So think about stuff like sin stocks and just anything that could expose me to adverse publicity. Auditors are very concerned about that because they don't want to get bad publicity or litigation related to a client, because that can cause future clients to be like, I don't really want to work with that firm. I don't want to hire them because they're associated with that other company where things went horribly wrong. And engagement risk, I want to clarify, the word engagement refers to a specific client in a specific year. So that one particular audit is considered to be an audit engagement. So when we say engagement risk, we're talking not just about the client, but the fiscal year audit as well. Now let's talk about the audit risk model and the various components. So we start off with a definition of audit risk. So audit risk is the risk that I, the auditor, issue an incorrect audit opinion. And the most feared version of this occurs if the client's financial statements are materially misstated and I sign off and say they're not materially misstated and give them an unqualified or unmodified opinion. So that's audit risk, risk of giving the wrong opinion. And we know generally it's really the risk that I give an unqualified opinion on financial statements that are materially misstated. There's really two components here to audit risk. The first component is the risk that those financial statements are materially misstated in the first place. So this risk kind of exists independent of the auditor, right? Those financial statements are misstated, whether the firm is audited or not, no matter who audits it. So that risk kind of exists, like I said, independent of the auditor. Then the second aspect of the risk is that the auditor comes in and they don't detect those misstatements. Okay, so they just fail to find them in their audit procedures. To conclude, in order to have audit risk, which is the risk I issue an unqualified opinion over materially misstated financial statements, that means two things are going wrong. One, the financial statements had the errors in the first place. Two, I failed to detect those material errors. So generally, when the auditor thinks about audit risk, we think about it on the level of the financial statements, because that is what I'm giving my opinion over, right? At the end of the day, I am giving you an opinion about the financial statements taken as a whole and whether they're materially misstated or not. However, the auditor does have to consider the individual accounts and disclosures. So we have to think about which accounts are most likely to drive material misstatements, which accounts are likely low risk. And these considerations will be built into our audit procedures, right? Because I'm going to spend more time auditing those accounts that I think are most likely to contain material misstatements. And I can generally spend less time auditing accounts that I think are at lower risk of being materially misstated. So now we're looking at the audit risk model here. AR, or audit risk, equals IR times CR times DR. And we're going to talk through each of these, IR, CR, and DR, and spend some time thinking about what each one of them means. What you need to know for now is, remember that we said audit risk is made up of two components, right? Risk of the financial statements being misstated and risk auditor doesn't detect it. So the risk that financial statements themselves are misstated is coming in from IR and CR. So IR and CR together, which those are called inherent risk and control risk, together they're known as the risk of material misstatement. So again, remember, these two risks exist independently of the auditor. These are just risks associated with the financial statements. Now, the risk that the auditor fails to detect the misstatements, that's DR, or detection risk. It represents how the auditor responds to the risk of material misstatements in the financial statements. So how is detection risk related to inherent risk and control risk? Or how is detection risk related to RMM, risk of material misstatement? These two are inversely related. Basically, when RMM goes up, meaning we think the financial statements have greater risk of misstatement, then DR goes down, because the idea is I want lower risk that I will fail to detect the error. And that's why it's called the auditor's response, because the auditor is really responding to high risk over here by lowering their detection risk to make sure they don't miss any of the errors over here. Similarly, when RMM goes down, when risk of material misstatement is lower, then my detection risk goes up, which basically means I'm allowed to do less work and allowed to do fewer audit procedures. Now, these are our formal definitions of IR, CR, and on the next slide, DR. So let's talk through those. So we know IR and CR make up the risk of material misstatement, but what are they? Well, inherent risk is the inherent susceptibility of an account to misstatement. Think of one client where their inventory is diamonds and another client where their inventory is coal. So when we think about inherent risk of theft for these items, diamonds are inherently more risky than coal, right? Because diamonds are very small, they're very compact, and they're much easier to steal. Coal is big, heavy, and dirty, so much more difficult to steal, especially steal it in high enough quantities that you're gonna make a profit off of it. So diamonds are more inherently at risk for theft than coal. Also, if you have an account like accounts receivable or cash that has multiple transactions a day versus an account like pensions that only has one journal entry probably hitting it per year when the actuary updates all the estimates related to pensions. On one account, lots of transactions are running through it. Pensions, very few transactions are running through it. In this way, cash and AR are more inherently susceptible to errors just due to the volume of transactions running through those accounts, right? They're more inherently risky than pensions. However, pensions obviously has a lot more inherent risk when it comes to estimating the appropriate value, right? A lot more judgment is involved, a lot more subjectivity is involved. So with respect to valuation, pensions are much more inherently risky than cash or AR. And when we say inherent risk exists independent of controls, what we mean is the following. If my inventory was diamonds, I would be putting a lot of controls around them to make sure they're not stolen, right? To help mitigate the inherent risk. So I would have security guards, a safe. No one is alone in the room when the safe is open. There has to be at least 2 people in the room if the safe is open. So when we are just talking about inherent risks, we're talking about them before all those controls are put in place, because that's really a separate issue. The inherent risk exists in the absence of controls. So speaking of controls, let's talk about control risk. So control risk is the risk that controls in place will fail to prevent or detect a misstatement. And therefore that misstatement makes its way through into the financial statements. So again, if we're taking our diamonds versus coal example, so one risk is associated with misappropriation of assets, right? If I don't have good controls around making sure my inventory is secure, someone could come in and steal the diamonds. And then if I'd never noticed, I wouldn't reflect that theft in the financial statements, so my inventory would be overstated. So control risk is basically how good of a job are controls doing at mitigating errors, preventing and detecting errors, and so on. If we think controls are bad, then control risk is considered to be high. If controls are good, then control risk is considered to be low. Now let's talk about detection risk. So we know detection risk is the risk that the procedures performed by the auditor will fail to detect a misstatement that exists and could be material. If we think about it with respect to risk of material misstatement, we know, and the inverse relationship, we know when RMM is high, I lower my detection risk. That means that I'm going to be doing more work, and the detection risk is lower because I want to accept less risk that I'll fail to detect a material misstatement. Detection risk is higher if I have accounts that are at low risk of material misstatement. It's higher, which means I want to do less work, but I am also willing to accept more risk that I will fail to detect errors. And this can be a little confusing because it feels like you would always want to keep detection risk at a low level. But remember, if you think accounts are relatively low risk, then we're willing to accept more risk on the detection risk side. And it's really about budget efficiency here, right? I want to spend most of my time doing work on the highest risk areas, which means detection risk will be low on those areas. If I've deemed an area to be relatively low risk, though, I'll be okay with doing less work and accepting higher detection risk in that area. And the reason why I'm willing to accept more detection risk is because I believe risk of material misstatement is low. So what are things that cause detection risk to increase? It could be that I'm doing the wrong audit procedures. It could be that I'm doing the right audit procedures, but I still fail to detect the error. And this is the case with sampling. If you remember your happy memories from statistics class, you should remember that sometimes I pull a non-representative sample when I'm sampling. And so in this case, I could, even if I'm doing the correct procedures, I could still fail to detect an error if I pull a non-representative sample, because maybe in the full population, there are a lot of errors, but maybe in the sample I pull, there just happen not to be any errors. And then I would reach an incorrect conclusion, even though the procedures I did were okay. Lastly, you may misinterpret audit findings. So this could be thinking back to our chapter 2 Tableau assignment, right? So maybe I notice that the customer they sell the most to is also not profitable, but I don't connect the dots. I just write it off to a poor operational decision on the company's part, and I don't connect the dots that it could be something that could be representative of a financial statement error. Okay, so like we talked about, if RMM is low, we can accept more detection risk. This means less work for us. If RMM is high, then I'm going to require detection risk to be low, meaning I'm not willing to accept much detection risk there. And I want to do more work around these particular accounts because I'm worried that they're going to be misstated. So this little chart is basically just showing us the same thing, but in visual form. So when keeping audit risk at a constant level, we notice as you go from high to low risk of material misstatement, that you'll go from low to high detection risk. And there are generally said to be 3 steps in applying the audit risk model. Step 1 is to set your planned level of audit risk such that you'll be comfortable issuing an opinion. So we said earlier, audit risk is the risk that I issue an incorrect opinion. And as an auditor, I can choose what level of audit risk I'm comfortable with. Now, what we tend to see with firms is it's either low or very low. And if we want to say it's in numerical terms, you could say you're willing to accept audit risk of 5% on the low end to 1% on the very low end. So you're never willing to accept high audit risk, right? But you're willing to accept low or very low. Now, what drives your set level of audit risk? It is generally factors that cause engagement risk to change. So if my engagement risk is low, then I'm generally pretty comfortable with setting a low audit risk. But if I think the engagement risk is high, then I'm going to want to go with, say, a very low audit risk. So when you're thinking about why an auditor would choose a particular level of audit risk for an engagement, remember it's the engagement risk that drives it. And engagement risk can be determined by, hey, do I think this company is maybe about to go bankrupt? Then that means engagement risk is high, and that means I would want to set my audit risk very low. Maybe I think this company is going public, right? If the company is going public, I know that is going to expose me naturally to more potential risk of reputational loss and more potential litigation risk, because public companies generally are exposed to more litigation than private companies. Also, with public company financial statements, they're out there, right, for everybody to see on sec.gov. Private company financial statements are much less widely distributed, so there are much fewer reasonable parties who could possibly incorrectly rely upon them if you get the wrong opinion. So if a company is public, that generally means engagement risk is higher, and you're going to want audit risk to be lower, or in this case, very low. But if a company is private, then engagement risk tends to be lower, and we're willing to accept a slightly higher level of audit risk. So I'd accept the audit risk at the low level for those companies. So that's my step one, right? Figure out my planned level of audit risk. Then step two is to assess risk of material misstatement. So figure out what IR and CR are. Now, I know, because we already discussed it, that IR and CR really are considered to be independent of the auditor, right? They exist out at the company regardless of whether or not the auditor is involved or the auditor is watching. So the auditor's job is really to measure the amount of IR and CR present in a particular engagement. And I'm going to do this generally at the account level. So I want to figure out how much inherent risk and control risk are associated with cash, how much inherent risk and control risk are associated with AR, and so on. So once I've taken the time, gone through all the material accounts, and figured out the risk of material misstatement with respect to them, then I'm going to basically solve the equation for my appropriate level of detection risk. Because remember, detection risk is the auditor's response. It represents how much work the auditor does. And so I know that the amount of work I have to do is going to be a function not only of my audit risk, but also of the risk of material misstatement. So we can kind of reformat the equation this way to show that we're solving for detection risk. And you're going to have a direct relationship between detection risk and audit risk, meaning if a company is a public company and I think they're going to go bankrupt, then we said I want to set my audit risk at very low. What that means from a detection risk perspective is that I'm going to want to do more work, right, to compensate for these various engagement risks. And that's why I've pushed my audit risk so low. So detection risk and audit risk have a direct relationship. As audit risk gets lower, I have to do more work, meaning my detection risk gets lower. As audit risk is raised, if you set it a bit higher, then I'm able to do less work, which means detection risk is increasing. Now, we already said detection risk has an inverse relationship with IR and CR, aka RMM. So I know that as these things get bigger, that means there's higher risk of misstatement, and I'm going to want to, again, lower my detection risk to compensate for that, meaning I'm going to want to do more work. And these pop-ups just say what we already talked about. So don't forget, step one, set audit risk based on engagement risk. Step two, measure IR and CR depending on the conditions out at the client that year. Step three, solve for DR, figure out how much work I need to do. So oftentimes in textbooks and CPA questions, they'll show audit risk, inherent risk, control risk, and detection risk numerically in this way. This helps a lot of people conceptualize it because you're kind of thinking about it in an equation format. And so it makes sense to see those direct and indirect relationships playing out if you're thinking about it as a formula. However, what you tend to see in real life, in practice, is these levels low, high, and moderate for the measurement of AR, IR, CR, and DR. Now, the reason why is because, so you'll never be able to measure these things or set these values with this level of precision. So that's why in real life, what we tend to see is these low, medium, high ranges, but conceptually, you can think about it as being numerical. So you'll notice in this example, audit risk is held constant, control risk is constant, and we see inherent risk falling. And then you'll notice as a result, you'll see detection risk rising from 0.01 to 0.1. Now, this example is one where inherent risk and control risk stay constant, but the set level of audit risk is increasing. So this shows the direct relationship between audit risk and detection risk. As the auditor is comfortable rising their accepted level of audit risk, then they'll also be able to raise their level of detection risk and do less work. These risk concepts in the audit risk model tend to be pretty confusing just because there's so many of them to keep track of. And don't forget, some are determined by the auditor while others are assessed and set, controlled by the auditor, right? And we have this little pop quiz down here. All else held equal, which of the following would imply more work or less work for the auditor? And I've actually converted this into part of your Chapter 4 activity. So you will see these questions and have to think through them again. So I won't go over the answers now. Now, the audit risk model, of course, like any conceptual model, it has limitations. It's a really helpful conceptual tool for the auditor, but there are problems. So for one, your desired level of audit risk that you set at the beginning of the audit, you may never be able to achieve that. And also, you may not even know if you achieve it or not, because you may believe that you've made sure the financial statements are free from material error, but there still is a lingering risk there that you may not have taken care of. Right? We could never actually know the levels of all these risks unless we did absolute assurance. It also doesn't think about potential auditor error. So this is particularly with respect to detection risk, right? If the auditor just makes mistakes in the procedures or is not doing the right procedures, then you're never going to quite get to your desired level of detection risk. And there's never a way to tell what those preliminary RMM numbers are with any level of precision, right? Unless we do absolute assurance and test every dollar. But it is a helpful planning tool to basically be able to list out all the accounts, say what we think the risks are associated with each, and then that can help us decide how much work we want to do around those accounts. All right, this slide is just to help you quickly think about or consider that there are really two types of errors when it comes to issuing an audit opinion. So we've spent the most time talking about the type 2 error, which would be when I issue an unqualified or unmodified opinion, but the financial statements are materially misstated. The type 2 error, as you probably remember from statistics, is generally thought to be the worst of the two errors. And it certainly is in the case of auditing, right? Because if we issue that unqualified, unmodified, when there's actually material misstatements, that exposes us to the potential for litigation. That exposes us to the potential to be humiliated in the popular press and have our reputation damaged, and so on. For the type 1 error, the explanation says you could conclude the financial statements are materially misstated when in fact they're fairly stated. Now, this isn't a real risk in the sense that if you think the financial statements are materially misstated, what you're typically going to have to do is do more work to understand and figure out those material misstatements. And so hopefully in the process of that, the client would be able to show you that no, in fact, they are fairly stated. There's no material misstatement here. The more realistic type 1 error, which I should add to this slide, in terms of audit opinions, is that I would give a client a going concern audit opinion, right? Which basically means I'm saying they're going to go bankrupt. and then they wind up not going bankrupt within the year. But that's the main example of type 1 error that people will talk about with respect to audit opinions. And again, worst case scenario for the type 1 error is you get fired by that client because they didn't like that you issued the going concern. With type 2 error, the consequences are much worse, right? Potential litigation, potential reputation loss. So type 2 is what I'm really scared of as an auditor.